Okay, welcome everyone. We're ready to start day 2 of the NABE International Symposium. We'd like to turn it over to our moderator, Ellen Zentner with Morgan Stanley.
Thank you so much. So welcome to day 2 of our International Symposium. I've got the honor today of speaking with Richard Clarida, Vice Chair of the Board of Governors of the Federal Reserve. Dr. Clarida joined the board in 2018 and has been contributing his deep knowledge of central banking history and helping to craft the new framework the Fed has adopted for conducting monetary policy. He's been a valuable addition to the FOMC for also having served the chief economic advisor to 2 past Treasury secretaries and on President Reagan's Council of Economic Advisors. There are many additional accolades that I could note here, but that would take the better part of our time with the vice chair today. So I'm going to invite the vice chair to provide his views on the outlook for the economy and monetary policy, and then we'll engage in a conversation followed by some Q&A. So Vice Chair Clarida, welcome, and the virtual floor is yours.
Thank you for that introduction, Ellen. And indeed, it is my pleasure to meet virtually with you today at the NABE International Symposium. So very much has happened since we last met in Washington back in February of 2020. But I am grateful that technology allows us to gather once again, if only virtually. As always, I look forward to my conversation with Ellen, but first do allow me to offer a few remarks on the outlook, Federal Reserve monetary policy, and our new policy framework. In February of 2020, none of us could have imagined that in a few short weeks, the COVID pandemic and the efforts put in place to contain it would deliver the most severe blow to the US economy since the Great Depression. GDP collapsed by more than 30% in the second quarter of 2020. More than 22 million jobs were lost. The unemployment rate rose to nearly 15%. And inflation plummeted in response to a collapse in aggregate demand that dwarfed the contraction in aggregate supply. But with the benefit of hindsight, it is clear that the economy has proven to be much more resilient than many forecast or feared 1 year ago. With timely support from both monetary and fiscal policy and the rapid development and deployment of effective vaccines, the economy stabilized and began a robust recovery in the second half of last year that both we and outside forecasters expect will pick up steam this year. So far, the economic activity data we've received is consistent with this outlook. For example, GDP rose by an impressive 6.4% in the first quarter, with real final sales to private domestic purchasers up an eye-popping 10.6%. Household spending on goods is rising robustly, and spending on services is also picking up as contact-intensive sectors begin to reopen and recover. Business and residential investment have more than fully recovered from the 2020 collapse and are operating above pre-pandemic levels. However, after looking at the details of Friday's disappointing employment report, the near-term outlook for the labor market appears to be more uncertain than does the outlook for economic activity. Employment remains more than 8 million below its pre-pandemic peak, and the true unemployment rate adjusted for participation is closer to 9% than to 6.1%. At the recent pace of payroll gains, roughly 500,000 per month, it would take until August of 2022 to restore employment to its pre-pandemic level. But what this necessary rebalancing of labor supply and demand means for wage and price dynamics will depend importantly on the pace of recovery in labor force participation, as well as the extent to which there are post-pandemic mismatches between labor demand and supply in specific sectors of the economy, and how long any such imbalances might persist. Readings on inflation on a year-over-year basis have recently increased and are likely to rise somewhat further before moderating later this year. Over the next few months, 12-month measures of inflation are expected to move above our 2% longer run goal, largely reflecting, I believe, transitory factors, such as a run of year-over-year comparisons with depressed prices recorded last year, as well as the emergence of some supply bottlenecks that may limit how quickly production can rebound in certain sectors. However, under my baseline outlook, these one-time increases in prices are likely to have only transitory effects on underlying inflation. And under my baseline, I expect inflation to return to, or perhaps run somewhat above our 2% longer run goal in 2022 and 2023. This outcome would be entirely consistent with the new framework that we adopted in August of 2020 and began to implement last fall. At FOMC meetings convened since last August, the committee has made important changes to our policy statement to upgrade our forward guidance about the future path for the funds rate and asset purchases to bring it into line with the new framework. As announced in our September 2020 meeting and repeated in following statements, with inflation having run persistently below 2%, our policy will aim to achieve inflation outcomes that keep inflation expectations well anchored at our 2% longer run goal. We expect to maintain an accommodative stance for policy until these outcomes, as well as our maximum employment mandate, are achieved. We also expect it will be appropriate to maintain the current target range for the funds rate until labor market conditions have reached levels consistent with our assessment of maximum employment, until inflation has risen to 2% and inflation is on track to moderately exceed 2% for some time. In addition, in our December FOMC statement, the committee combined our forward guidance for the funds rate with enhanced outcome-based guidance about our asset purchases. We indicated that we will continue to increase our holdings of Treasury securities by at least 80 billion per month, and our holdings of agency MBS by at least 40 billion per month, and still substantial further progress measured relative to our December 2020 announcement has been made towards our maximum employment and price stability goals. In our new framework going forward, a low unemployment rate in and of itself will not be sufficient to trigger a tightening of monetary policy, absent any evidence from other indicators that inflation is at risk of moving above mandate consistent levels. With regards to our price stability mandate, while the new statement maintains our definition that the longer run goal for inflation is 2%, it elevates the importance and the challenge of keeping inflation expectations anchored in a world in which an ELB constraint is binding on the federal funds rate in downturns. To this end, our new statement conveys the committee's judgment that to anchor inflation expectations, it will be important to conduct policy to achieve inflation outcomes that keep inflation expectations anchored at our 2% goal. As Chair Powell indicated in his Jackson Hole remarks, we think of our new framework as an evolution from flexible inflation targeting to a flexible form of average inflation targeting. While the new framework represents a robust evolution in our monetary policy strategy, this strategy remains in service to the dual mandate goals of monetary policy assigned to the Federal Reserve by the Congress that remain unchanged. In closing, notwithstanding the recent flow of encouraging data on macro activity, the economy remains a long way away from our goals, and it is likely to take some time for substantial further progress to be achieved. Our guidance for interest rates and asset purchases ties the path of the funds rate and the size of the balance sheet to our employment and inflation goals. We are committed to using our full range of tools to support the economy for as long as it takes until the job is well and truly done. Thank you very much, and I look forward to my conversation with Ellen. Thank you.
Thank you, Vice Chair Clarida. Thank you for laying out your baseline expectation. I do want to talk about some of the data that we've just gotten today, but before I do that, could you lay out sort of how you're thinking about the upside and downside risk to that baseline expectation?
Well, thank you for that question, Ellen, because one thing I have found as a Fed official is that many observers focus, I think, excessively on the baseline, and monetary policy is about the balance of risk as well. So we have a very constructive baseline for the economy, potentially the fastest growth in 35 years. and very strong gains in the labor market and declines in the unemployment rate. But around that baseline, there are risks on both sides. I'll talk about a downside risk and then an upside risk. On the downside, there's been very welcome progress on vaccinations, but we're still not at the point where the populace is full or amply vaccinated. There's also the risk of a development of a new variant of the virus that would be resistant to vaccines. And obviously, there's a downside risk to the global economy because many other countries in the world are lagging behind the US in terms of vaccinations. And as Chair Powell and we have said many times, ultimately the course of the economy is going to depend on the path of the virus. That's not our baseline. We have real grounds for optimism, but that's a downside risk. On the upside risk, there's enormous pent-up supply in the economy with at least 8 million folks who had a job 14 months ago who don't have a job, but there's also substantial amount of pent-up demand with fiscal support and with nearly $2 trillion of accumulated savings that could be spent faster than we think. And so on the upside, we could have more imbalances, persistent imbalances between aggregate demand and supply that would put more persistent upward pressure on inflation than we and outside forecasters expect. And let me be very clear, Ellen, if contrary to our baseline view, demand relative to supply was excessive and persisted and pushed up inflation and inflation expectations to levels that were not potentially consistent with our mandate, we would not hesitate to act and to use our tools to bring inflation back down to our 2% longer run goal. So our baseline view, as I indicated in my opening remarks, is that most of these increases in inflation relative to 2% will be transitory. But let me also say, Ellen, that it may take longer to reopen a $20 trillion economy than it did to shut it down. When we shut down big parts of the economy last year to deal with the virus, that put substantial but largely transitory downward pressure on the price level. And reopening the economy is putting some upward pressure on the price level, and we will need to be attuned to the data and following it closely. But that is the balance of risk around our baseline outlook.
Thank you for that. So is it fair to say then the inflation data that we received just prior to beginning day 2 of this conference, significant surprises to the upside? Was there anything in the report that seemed unexpected?
Well, again, we've been saying for some time that reopening the economy would put some upward pressure on the price level. I was surprised. This number was well above what I and outside forecasters expected. Quite frankly, I was getting ready for this interview, so I have not looked through the report in detail. But obviously, we have pent-up demand in the economy. It may take some time for supply to rise up to the level of demand. And as I said, as a Fed official, we are looking at data. We're really not outlook-based. We're outcome-based. This is one data point, as was the labor market report. But over time, we'll be taking signal from this data, and it's going to be very important that any pressures to inflation that arise be transitory. And if they're not, as I said, we would use our tools to bring inflation to our 2% longer run goal.
Great, thank you. And just before we get into some meatier topics here, if I could stick to the data. You've been a data watcher before. You're still a data watcher at the Fed, but maybe you move at a lower frequency now. But the payroll report from last Friday, we got the April employment data. It was taken as a disappointment. The economy created just 266,000 jobs. And the job creation that we had in March was revised lower. Chair Powell referenced the 8.5 million jobs shortfall compared with the pre-COVID level. And with this data and the revisions, we're about 8.2 million below that pre-COVID level. Are you surprised that we've not made more progress thus far?
Well, I am. My view was not dissimilar to the view of most outside forecasters, which which built in the fact that given the unemployment and the true unemployment rate closer to 9%, and the slack in the labor market, that we would expect very strong numbers in coming months, and the downward revision to the prior month and the roughly $200,000 print was a downside surprise. As I pointed out in my opening remarks, if you average across, and it's probably useful to do some averaging, but if you look at the last 3 months with revised data, in any other time, 500,000 jobs per month is a gangbusters number. But the labor market's in a deep hole, and as I indicated in my remarks, at that pace of 500,000 per month, it would take really until almost the fall of 2022 to close that gap in the labor market. So yes, I was surprised, and as I think were most outside forecasters. And I should also say, Ellen, that we'll be getting more data on the economy. This was an unprecedented shock. It has sort of tore up the playbook in terms of how to think about the business cycle, and we need to be humble in that perspective and really draw lessons from the data as it comes in. So I'll certainly be doing that, as I'm sure my colleagues will.
Thank you. So let me talk about another piece that was in that employment report, because it does start to get into inflation. So labor costs have been rising. We've seen all the company surveys, business surveys telling us that they're having to offer higher wages to attract workers. And it's easy to see that there are distortions around COVID that are also creating that. But where do you come down on the debate among the economics community, within the economics community, of labor costs, and are they sticky? And how would you fold that into your expectation for inflation?
Yeah, well, it's an excellent point. As I mentioned in my remarks, one thing I'll be looking closely at is the movements in participation. As you know, this was an unusual downturn in that we had such a big decline in participation, nearly 3 percentage points. And so I think over the medium run, the answer to that question in terms of balancing demand and supply in the labor market is going to depend on participation. If participation, especially prime participation, moves back up to where we were 14 months ago, there will be less persistent upward pressure on wages than otherwise. So I think following participation closely is going to be very relevant there. In terms of the inflation picture, you have to balance labor cost against productivity as well. And obviously, a very unusual feature of this downturn and recovery has been very, very strong productivity growth. I don't have the number at my fingertips, but it's twice what we were seeing before the pandemic. So that's probably transitory as well. So I know I'm repeating myself, but there's a common theme here. As we reopen a $20 trillion economy from a catastrophic shock, there are going to be some imbalances, and there are going to be some features that were not evident in prior cycles, and we need to be especially attuned and attentive to the data to draw the right lessons.
Why do you think there's been a lack of available labor? I mean, if we've got more than 8 million people that are still unemployed versus pre-pandemic, why does it seem like we're getting information that would suggest people are reluctant to go back to work? What is your take on that?
I think this is one of those important questions in which there's no one answer. I think there are several factors at play as I talk to our staff and read outside research, including yours, Ellen, at Morgan Stanley. I think there are a couple things. I think that there are a lot of women in the labor force who were in the labor force who, at least during COVID, have stepped out because of either healthcare responsibilities or schooling for children. I frankly also think that I think there's hesitancy for a lot of folks to go back to work in the service sector, because although we've made progress on the coronavirus, we haven't beaten the coronavirus yet. So I think those are both important. I think those are both important factors. And then thirdly, I think there may be a period of time in which there is an elevated amount of job search required as the economy changes in some important ways relative to the pre-COVID experience. Some service sector employers that formerly were open are no longer open. There are new businesses opening, but sort of matching workers with companies may take some time. And so I think there are a number of factors at play here, but I do think participation and probably some very understandable hesitancy to return to contact-intensive service sector employment may be with us for some time.
Thanks, and maybe last on that, in that vein, you know, I know that we can't see it in real time, but you know, we've had a much higher rate of retirement. You know, that happens in every downturn, but this has been significant. And there could be other structural issues where workers just don't come back to the labor market. And, you know, there's been more recent research that this could push NAIRU up, or full employment up, you know, have implications for what is that level of maximum employment. If that is the case, how would you expect to be able to uncover that in the data, or what would you be watching for? What would be the implications of that?
Ellen, I think that's an excellent question. So thank you for asking it, because I think, speaking for myself, obviously, as we always do, to me, that is really one of the critical issues for the next several years. In our framework review, one of the things that we realized, and I should say that the Powell Fed realized in several years before we shut down the economy for the pandemic, is that whatever U-star the maximum rate of unemployment is, it's something that varies over time for structural reasons. And it was much lower at the end of that cycle than many folks thought several years before that. The unemployment rate got down to 3.5% with really no excessive upward pressure on prices. Wage gains were healthy, but they're more or less in line with productivity and underlying inflation. But another thing that surprised in that cycle, Ellen, was we got a late cycle, or a mid-cycle, which unfortunately turned out to be a light cycle because of the pandemic. We got a mid-cycle increase in labor force participation that was quite welcome. So as the economy expanded 2017, 2018, 2019, labor supply went up, prime age participation went up, and also workers 55 and older, their participation rates, while lower than the younger population, nonetheless were going up. But let me say, you know, that's not an immutable law of physics. Labor force participation evolves for a number of reasons. And so I do think that going forward, speaking for myself, we have to be very attuned and attentive to see how the post-pandemic labor market clears. And we have to be looking at participation. We have to be looking at productivity. And that means, at least for me, I'll be looking at trends in wages, in compensation, relative productivity, both in the aggregate and across sectors. And I think that's going to be a very relevant set of data to be looking at.
Thank you. So I want to touch on something that you talked about in your CNBC interview last week. And in that interview, you had alluded to the fact that the 5-year break even was higher than the 5-year forward. So financial markets were pricing in short-term inflation lift, and of course they seem to anticipate correctly that inflation is rising here in the near term, but that longer-term expectations were more stable. So the question really is, what kind of dynamic in the 5-year would catch your attention, and do you think there's further room to rise and still be consistent with anchored inflation expectations?
Great point. Let me make several observations. First and foremost, and I've also given speeches on this as vice chair, I think inflation expectations are critically important to monetary policy, but there is no unique measure of inflation expectations. And so I put a lot of weight on surveys. I do look at financial market indicators, but I tend to look at measures that the Fed staff makes publicly available that attempt to strip out liquidity and term premia. And as I look at those numbers from the TIPS market, they're very consistent with market expectations for PCE inflation right around 2%. The survey of professional forecasters, if you look at the Bloomberg consensus panel, so baseline views for inflation, I think, are very consistent with inflation expectations being, anchored and certainly very close to our objective. It is unusual if you look. The TIPS market was created by Mr. Summers and Mr. Rubin, 25 years ago, and it's an enormous contribution not only to financial markets but to looking at data, because it gives you a noisy but high frequency signal on market expectations. It is actually quite unusual if you look at the data going back to the 90s for five-year forward break-evens to be below 5 and 10-year break-evens. But to me, it is a signal that, as noisy as those indicators are, they are indicating that whatever price level pressures that may hit the economy are likely to be largely transitory. So I wouldn't give you, a number or a level, because I think it would be important to try to factor in liquidity and term premia elements. And then finally, your question will enable me to get in a plug for some very fine work done by the Fed staff, who've come up with an index of common inflation expectations. It's updated quarterly. It's now on Bloomberg. And essentially what it does is it's agnostic in that it looks at 20 different measures of inflation expectations and extracts a common factor, common component. And I know many folks have done versions of that outside the Fed. But for whatever it's worth, that index is also showing inflation expectations very close to 2%.
Thank you. Yes, that's an excellent measure, I have to say. And it's great to see that work around it coming out of the Federal Reserve. So perhaps we can shift here and talk about other central banks. So we've got the Bank of Canada and the Bank of England, who have begun to scale back the pace of their asset purchases. And so that leads to the obvious question, when and how will the Fed begin to scale back its quantitative easing program?
Excellent point. I won't make a lot of news here. Our guidance has been very, very specific and unchanged since December, when we first put the language in terms of reducing the pace of our purchases. I won't use the T word, reducing the pace of purchases. We want to see substantial further progress towards our dual mandate objectives. I mean, right now that means focusing especially on the labor market. I think it's fair to say that sitting here in the middle of May, we have not made substantial further progress towards our labor market objectives. Again, as I and others have indicated, we are really outcome-based, not outlook-based. And to be honest, I think the most recent employment report conveys the wisdom of that approach. We all have to resist, and again, I plead occasionally guilty here too. We have to resist the temptation to convert a forecast into an actual outcome. Most people saw the most recent employment numbers in the range of 900,000 to 1 million. It was the biggest miss in history, and so I think it will serve us well to be outcome, not outlook based, especially in an economy that's buffeted by the challenges of reopening from the pandemic. But what I will say, Ellen, is as we go through the year, we're going to be getting a lot more data. We'll be able to form some judgments. When I say we, the committee, we will be assessing what that data means relative to the metric we put forward, which is substantial further progress. And as Chair Powell has indicated, as we discuss that at the FOMC and we form those judgments, then we will communicate well in advance our views about when it will be appropriate to begin to slow the pace of purchases. So I'll just leave it at that.
Thank you. So I think, really that encompasses a response to what was going to be my next question, because there have been some critics that believe we're now past the time for extraordinary monetary policy support. And so you would say to that, not yet.
I would say to that, not yet. Again, I think some perspective is very relevant here. When Chair Powell rolled out our new framework in August of last year. So 9 months ago, a common criticism was the Federal Reserve was unable to get inflation sustainably to 2%. Why do people think we will now? And shows you how quickly things can change. Vaccine development, policy support. So we need to take a more medium-term view of this. Again, we are going to be attentive and attuned to the data. We do have a dual mandate. So this is not only just about the labor market, but about inflation developments. But I think honestly, we need to recognize that there's a fair amount of noise right now, and that it will be prudent and appropriate to gather more evidence before we make that judgment. So I'll just leave it at that.
Thank you. So I want to talk about the central bank and inequality. So I would love to hear your thoughts on, what does broad-based and inclusive mean? Whether it's when you think about the Fed's, well, primarily when you think about the mandate of maximum employment.
Excellent question, because that is one of the new elements of our framework that we chose with unanimous support, that we chose to emphasize in our new framework document, that we recognize that maximum employment, which is a statutory directive to the Fed. So just to remind your viewers, the Fed is a creation of Congress, and our mandate is in statute. And the mandate is maximum employment and price stability, also moderate long-term interest rates, but we typically focus on the dual mandate. And so what that language means to me is simply that there are enormous benefits to operating an economy at maximum employment and keeping them there that are well beyond just an individual number. The unemployment rate's 3.5%, which is where we got to last time. And in particular, economists have known for decades that, unfortunately, a common pattern in business cycles is that for different groups of workers, and particularly different demographic groups and groups with lower levels of education, the rising tide only begins to lift those boats towards the middle of the cycle. I won't get into whether or not you need a hot labor market or a warm labor market, but progress is uneven in economic recoveries. And so what this means to me is that there is a substantial societal benefit to getting to maximum employment and keeping the labor market there. And I think under Chair Powell's leadership, I think that the committee made the right choice. Again, we had our critics in 2019 who said, why are you downshifting rates by 75 basis points? Well, we saw PCE inflation falling below 2%, and we saw no evidence that a low unemployment was putting upward pressure on inflation. So I think we made the right call in that labor market. Now, that being said, we have a very, very powerful set of tools, but they're pretty limited in number. We basically have 3 tools in the toolkit. We can raise or lower the funds rate. We can give some guidance on the path of the funds rate, or we can buy treasuries and mortgage-backed securities. And what those tools have in common is they tend to impact economic aggregates. And so they're effective at helping to support economic growth in GDP or to lower the unemployment. But they're not well suited to eliminate disparities across demographic groups or groups with different levels of education. And really, so what this means to me, broad-based and inclusive, is the value of getting to maximum employment and keeping the economy there is substantial. I should also say, in terms of inequality, because I think that was either implicit or maybe explicit in your question, the reality is that when people who are unemployed get a job and labor force participation goes up, that does a heck of a lot for income inequality by folks who are unemployed actually converting that into employment, getting experience, perhaps being able to get a raise. And so I think that if you look at income inequality, by achieving maximum employment and keeping the economy there, our policies do a lot to help improve income inequality, especially with a fully employed economy. Wealth inequality is a more complex subject, because it is the case that right now the funds rate is close to zero. We are doing large scale asset purchases. That is supportive of financial conditions. We think that continues to be appropriate given the hole in the labor market that we're experiencing. And so that's the way that we're balancing that right now.
Certainly, that's been an extraordinary shift, the focus of monetary policy on this concept of maximum employment. Let me go back to the broad economy and ask you a question that is probably certainly fair game in an international setting as we are right now. So the U.S. economy seems to be poised, especially on your outlook, your baseline, to be a locomotive for global growth this year. And so what does that do to its current account balance? And what are the implications of that?
Yeah, well, economics is hard, but arithmetic is a little easier. And putting on my professorial hat, because I taught international macro for 30 plus years, and week one is the saving investment identity. And so in an economy where you have a rise in investment relative to saving, you're going to either have a smaller current account surplus or a bigger current account deficit. I do expect the current account deficit to widen. I think we will buy the growth in our import demand will exceed the growth in our exports, in part because this will be a somewhat unusual cycle. If the forecast plays out into reality, with the U.S. growing well above the global average. I mean, right now, I think the consensus is for Europe to grow in the 4s and Asia to grow in the 5s, depending on which emerging markets you're looking at. Somewhere in the U.S. this year, according to the baseline outlook, is 6 or 7. That's a pretty unusual configuration, but it does have a consequence that it's very likely that our current account deficit is going to increase this year and potentially in the future years. And so that obviously has repercussions for the global economy as well. I should also mention, Ellen, and I've written about this again before I joined the Fed, an important shift in the U.S. and really global economy, the era of globalization, particularly relevant for the U.S., is in cycles where there is a rapid growth in demand relative to domestic supply. A safety valve in terms of price pressure, at least for the traded goods part of the economy, is the trade deficit. And the U.S. is, relative to many other countries, relatively closed, but relative to where it was 30 or 40 years ago, much more open, especially with trading good and many services. And so I think that's another factor that's relevant in thinking about the medium-term inflation outlook.
Thank you. So we are about 12 minutes out. I want to be sure to get to some Q&A because we've had a lot of great questions come in. And they're really, I think they're really interesting questions because they cover a lot of different topics. So I'm going to try to whittle that down to just a few broad topics and probably be able to cover a lot of them in just a few questions.
Good.
So I know that's always, for the speaker, that's always good news. So the Biden administration has proposed this Build Back Better plan. Let's just focus on the infrastructure piece of it and just generalize, no specific policy questions. Just when you think about infrastructure spending in the economy, in an economy where we have fallen short from trend of what we used to spend on infrastructure, how would you think about that in terms of how policies like infrastructure might lift the labor market, might lift productivity? How would you think about that when you're thinking about the longer term outlook?
Yeah, well, again, at the 30 or 60,000 foot level, I think there's broad agreement among many or most macroeconomists that the U.S. has been underinvesting in infrastructure. And so, intelligent, well-deployed infrastructure investment, promises to boost the level of productivity, which is a good thing. It is obviously a decision for the legislative and executive branch on how to actually structure the package and how it's directed, but certainly at that level. And again, I think also the expectation would be, if we were to get a bill, the outlays would be spread out appropriately over 5 or 10 years. And so I think it is fair to say that I broadly support the idea that well-conceived and deployed infrastructure would be welcome in the economy, because I think we have underinvested.
Do you think something like that lifts longer run productivity might feed through into potential GDP? Is it something that could arrest this long-term decline in neutral rates as well?
Yeah, well, that's a good question. The short answer is yes, potentially. Again, as in most things, it would depend on the on the details. And I think ultimately neutral rates are probably more connected to underlying growth and the level of productivity. But if you get a level shift in productivity over a decade, as that's happening, it looks like faster growth, and it might well show up in neutral rates. That will actually give me an opportunity to plug some very nice research by the Fed staff, which just appeared as a Fed's working paper in the last week, in which they build a very, very rigorous econometric model of global real interest rates, factoring in the global spillovers and really looking specifically at demographics and productivity trends. So it's a long paper. I won't summarize all the results, but that's certainly consistent with what they find as well. I should also say that faster productivity growth, other things being equal, is disinflationary. And so that's another thing we would need to think about as we're looking out 5 or 10 years.
Or maybe actually that folds into another question, because while it could be disinflationary, could it simply act as a governor on inflation if you've got other tremendous inflationary pressures coming? Because there is a question here of, there's a lot of tolerance for overshoot on inflation in order to re-anchor inflation expectations or be sure that inflation will remain around that 2% level. What happens if you get to 3% or greater inflation? I mean, is there unlimited tolerance for that? How should we think about something? I don't know why everyone always asks us around 3%. It's like that magical number.
Well, let me give a very, very direct answer. And a fundamental pillar of our new framework and of the prior framework in 2012 is that with regards to price stability, having inflation expectations well anchored at the 2% longer run goal is an essential element of price stability. And speaking for myself, I'm going to be looking at those various measures of long-term inflation expectations very closely. I don't think it's particularly useful, given the complexity of the real world, to pick out a particular number in terms of the data flow. But what I can tell you is if I were to see any evidence that measures of inflation expectations over the medium term, say 5 to 10 years in the future, were drifting up, I would take that very seriously as something that would be inconsistent with our price stability mandate.
And so actually, you're doing a great job here, because everything you answer flows into another question. It's a question in the list of what
folks,
we've gotten.
we've not prearranged. This is not like the game show scandals from the 50s. We've not prearranged this, so my luck will run out now, I'm sure. Yeah.
Yeah, we truly haven't. But in that case, what are the appropriate steps in terms of the order of operations that the Fed would take, were it to get it to a point in the cycle where we see longer term inflation expectations start to become unanchored or at an uncomfortable level? What would be sort of the first thing the Fed would do?
Well, I think here, Ellen, I'm going to basically say what I said a moment ago. I think Governor Brainerd made a similar point yesterday. Chair Powell has made this point. And so what we have a toolkit: guidance, the policy rate, and the balance sheet. And what we said is that if we saw evidence that there was a risk of a persistent upward drift in inflation expectations, we would not hesitate to use our tools to offset that and to bring inflation expectations down to 2%. I don't think it's helpful now to talk about sequencing or lines in the sand, but we would use our tools to achieve that objective.
Certainly, we've seen the Fed communications be quite powerful, and a pretty easy first first step. So we've got about 5 more minutes here. There's been several questions of different flavors around supply chain issues. So we've seen a range of supply chain issues disrupt production, logistic networks. How does that influence your views on inflation? Will these supply bottlenecks be transitory in your view?
Well, I think historically, if you look at, for example, episodes where you've had, say, a hurricane or a flood in an area, you do get bottleneck effects. You shut down the economy, you reopen it, and you do get those level effects, but they don't tend to persist for very long. So I think most of the plausible bottlenecks that we can think of are likely to be transitory. Again, notice likely. We're going to have to look at the actual data. Ultimately, the record shows that the U.S. economy has been able historically to bring labor demand and supply into balance. But as I said earlier, it may take some time to fully reopen a $20 trillion economy. Shutting down the economy put downward pressure on the price level that turned out to be transitory. And it's very plausible that reopening the economy may put some upward pressure on the price level that I would think would be transitory. But again, we're outcome-based, not outlook-based. And as the data flows in, we'll be able to form a more refined judgment on that. I should also mention, Ellen, that not just the US, but the global economy is reopening after shutting down last year. So you are seeing, especially I think in commodity markets, evidence of that. It's not just the US and US policy, it's really a global reopening that in some ways is reversing what we saw in those markets last year.
Thank you. All right, we're coming down to the wire. And what I've done is I've combined a few questions that have come in, still on the topic of inflation and also transient. So the one is very simple, is can you define transitory? Is it 1 year? Is it longer than that? And that I'll combine with another question that was that is similar. How long would inflation have to stay high before the Fed begins to view those price increases as more than just transient?
Well, what I can say is it's certainly too soon to tell right now. Again, expanding this beyond the Fed, as I look at the outside forecasters that I respect, the general feeding, so it's not just unique to the Fed, is that on a year-over-year basis, the baseline view is that the maximum increase in inflation is really going to be experienced as we move through this year, and as we get into next year, many folks expect inflation to move back towards 2%. In fact, many forecasters out there I respect are saying that the issue a year from now may be core inflation running a little bit below 2%. So I think there's an unusual degree of uncertainty here, and I would leave it. I would leave it at that. And just again, I sound like a broken record for those of you who remember what broken records look like. But the reality is that price stability really over the medium run is about well-anchored inflation expectations. And to me, critically monitoring evidence of what we're seeing in those expectations is going to be an important factor in thinking about the appropriate stance of policy and the way we communicate policy.
Thank you. Well, I think we're going to have to wrap it there. I had thought that most of the questions would be around inflation, but there were a lot on maximum employment as well. So it seems like folks are looking at it in a 50-50 way, as they should, given the dual mandate. But I want to thank you for being so generous with your time today. It's been a pleasure to have you join the International Symposium, and we hope to speak again with you soon. Thank you, Vice Chair Clarida.
Thank you, Ellen. Good to see you.